presently looking at the British pound USD. And if you're asking questions or posting anything, I'm not looking at that this morning because I want to focus on the delivery of the material. And we're going to refer to the dollar only this morning, the British pound USD, and we're going to reflect on the Australian dollar versus the US dollar. Okay, so when we go through exercises in the evening time, I'm going to send you, typically I'm going to send you 1 or 2 charts going forward from starting last night, and I want you to focus primarily on the things that I have covered thus far. Do not try to apply everything you've probably seen in the free tutorials. If you're a member that has gone through all those free tutorials, like I said, you're kind of at a disadvantage in regards to the new student because you're going to be able to learn it in a much more expedient way by just applying what you find at the incremental stages I present the material. So everything that we've covered so far for this month, that's the only thing I want you focusing on. So when you go into the charts, don't look for mitigation blocks, don't look for propulsion candles, none of that stuff. Only things we've talked about so far is consolidation, expansion, reversal, those ideas of how price moves from one place to another, the speed at which it moves, old highs, old lows, okay? I don't want you to try to apply everything, and that's the reason why a lot of you have fumbled for a while, because you're thinking I apply every one of the things I do with my concepts to every possible condition. And the beginning stages of your understanding is you have to start with very few tools, with very few conditions in the marketplace. So having these limited perspectives is actually an advantage. It's not a myopic disadvantage, okay? You're actually focusing in on the things that matter most right now. It's not important to have an expectation of trend following concepts when the market's in consolidation. It has to move out of that consolidation first. Okay, I'm just giving an analogy. So when I give you charts to study, okay, it's leading you to what you should be expecting to see coming into the next trading session. That way you can refer to what the chart looked like at the time I sent it. You can start noting on your own charts what your expectations are. Now, that is not an invitation to send me emails asking me what your trade idea looks like. And it's also not an invitation for you to send them on Twitter, because everything you send on Twitter to me, all of your followers see that. And we're going to gradually be moving into more sensitive content, and I don't want that being shared with the public. I don't want that done. So if you're sharing things, if it's a chart or something like that, and you want to send it to me by way of Twitter, post it on the forum, and then send the link through the forum. That is not an invitation to send me emails asking me what your trade idea looks like. And it's also not an invitation for you to send them on Twitter, because everything you send on Twitter to me, all of your followers see that. And we're going to gradually be moving into more sensitive content, and I don't want that being shared with the public. I don't want that done. So if you're sharing things, if it's a chart or something like that, and you want to send it to me by way of Twitter, post it on the forum, and then send the link through the forum by way of Twitter. Don't just send a chart to me, because everybody can see that. So if you have followers and you send a tweet with the link to the forum, they can't get into the forum. So it's a secured link. But when you're just sending me pictures, okay, or charts, everything on that chart and anything that's in your pictures or photographs, if it has content in there, I'm going to flag you and say, hey, please take that down. And I don't want to have to be doing all that. But that's not what this is for. I do not want you to use me as a sounding board for every exercise we do, because I can't have 700 of you sending me messages every single day. I'm not going to be able to get through it. I got lesson plans I've developed on the daily with you. I'm answering administrative emails and stuff. I don't have all that time to do it. So I have a procedure in mind, okay? And really, nobody's with you when you do your learning. That's your time with the price action. You study in the intimacy of your solitude with price. That's how it's done. Okay. When we do live exercises in the live session, obviously that's a different dynamic. But when I give you study, okay, I give you homework, I want you to do that independent from anyone else's influence. Don't ask everybody else what they think they see. If you're in private groups and stuff, and or if you're on Twitter, you know people in the mentorship, don't compare notes. That's not going to help you. Trust me. If you get it wrong, or if you miss some things that you didn't see at the time when you're studying, that's the purpose, because it will illuminate the things that you're weak on and highlight that. If you don't understand where you're weak at every single month when we do something new and we apply a new concept, you're going to fall behind because you're expecting the answers to be given to you. Don't do that. Study, make notations in your own chart, write down what you anticipate seeing in price. It's not the same thing as getting in and taking a trade. All you're doing is learning anticipatory skills. It's hard in the beginning because you want to do trading, but you can't do trading efficiently without understanding what you're looking for. This is how it starts. This is how it's done. Okay? There is no shortcut. This is exactly how you're going to learn it. There's no better way of doing it than this. Believe me, trust me when I tell you, it will pay in dividends in your understanding. So when I gave you the chart last night, the only thing that was different that's on the charts now is I re-highlighted the lows here on the daily chart to the left, and I added this shaded area here, which we'll talk about as we go. But let me scrunch this up a little bit more because I need a little bit more data to show on my 15-minute chart. There you go. Now, when I'm watching price, when I'm doing live sessions and such, I actually have another screen that I'm having 3 charts on. Without having all the extra clutter on here, I'm just going to focus primarily on the 2 I pay most attention to. Looking at the daily chart, and I usually have it on the left-hand side so I can constantly refer to how the daily range is expanding or if it's contracting. And I'm actually watching the executable time frame that I'm working off of, which is usually the 15-minute time frame. That's usually on the right-hand side. Now, you don't have to be exactly like this. It can have reversed whatever way you want orientation. But I usually have a higher time frame chart that I'm constantly referring to, and it's always the daily chart. And I look at the 15-minute chart as what the intraday price actions developing. In addition to this chart here, I'll have an hourly chart, and that sometimes will toggle back and forth between a 4-hour and a 1 hour. So I'm actually have 3 charts up at one time, and that usually will have the 4-hour sitting above here. So there'll be a smaller chart up here of the 4-hour or 1 hour. The daily would be on the lower end down here, and then the biggest portion of the screen would be where I'm watching live price action through a 15-minute chart. And I'll show you all that stuff, when we start getting into the entries and actual trade executions. But for now, I want you to still focus on small little segments of the ICT content, not trying to apply everything to every condition. Last night, I tweeted a chart. Let me take this off. And I'm actually going to leave the shaded area on here for now on the 15-minute chart. So I showed the daily chart reaching up into here. We talked about this yesterday, 130.93, which was the bodies of the candles over here. If you look at the close, 130.93. And I'm going to ask you a question, and it's rhetorical because I don't know. I don't want to look at the questions because something's going to come up invariably and distract me. But in here, all of this consolidation right in here, this little consolidation, what is actually going on behind the scenes? What's the underlying condition of what this consolidation was producing? Well, if you look at what was happening prior to the consolidation, we had come off of a high and traded lower. Once we traded lower, okay, market moved into a small little consolidation, and then it expanded up, and it took out a previous high. Not only did it stop the individuals that were short with stops above this high here, it continued to expand higher, reaching for liquidity where? Above this old high. Okay, so when price comes back down through this consolidation, what would we reasonably expect to see in terms of price, and why? Well, the consolidation here that sees expansion, this is all buying by smart money to drive price up above old highs to knock out shorts. When the market comes back down through that low, not only do you have a market structure break, but you also have a specific level to watch for new selling. We talked about this specifically live yesterday, saying that we want to watch how price comes back up into these buys of this candle, and that should stave off any future advancements. Once price hit that level, it only went 1 pip above it. The high come in at 130.94, and we were looking for 130.93, so that's pretty good. Quickly rejected, nice wick formed, okay? And now once that level has been retraded to, what level do we consider after that on near-term resistance? These old lows down in here. Why? Go back over here left. What's this little candle here? That's the bottom of these two dark black candles, okay, or bullish order block, or mitigation, which we'll talk more about as we go, but for now, just understand that it's basically a support level broken, now it becomes resistance. So if we apply a level of horizontal okay, what is the low here? The close rather. 130.63, 130.63. Then we have these lows down in here, just piercing through a little bit. The lows come in on it at 130.62 and 130.62. So we have two candles here at 130.62 and the body of the candle at 130.63. 130.62. It'll have to be have to do for that right now. So 130.62 to 130.63 should be sensitive, but we round that to the even 5 number or the even 60. So in other words, going back to this level, we're highlighting 130.63 to 130.62 as the specific level, but we round up or down. If we're below price, if we're below this level here, obviously we're below over here, would we round up to 130.65 or round down to 130.60? We will round down to 130.60 because we're looking for the least resistance of getting our objectives. So if 130.60 is the level we'd be looking for, because we're rounding down to get institutional pricing. Institutional pricing is just a model we use for rounding to the nearest 5 level or 0 level. And it doesn't have to be an 80s or 20 level. Good grief. Okay. So now we have our level 130.60 relative to the breaker. I'm sorry, the well, it is a breaker, but it's also a mitigation block because we're both below it. These equal lows in here we've considered, but we rounded down to the nearest round 0 level, so 130.60. Excuse me. So over here we take that same level 130.60 and we transpose it to our lower 15-minute time frame chart. Just right-click on the chart, on the line, calibrate it to your level that you want to look at. Now you have your level on your lower time frame chart. Okay. So now what I want to ask you is we understand that the market generally makes the high or low during the London Open. Okay, London Open is between 2 o'clock in the morning and 4 o'clock in the morning Eastern time, or my local time, basically New York time. Okay, so know what time it is in New York. Between 2 o'clock in the morning and 4 o'clock in the morning, you have a huge probability that the high or low forms, and that's just basically London Open. Okay, the kill zone is a lot more in terms of time than that, but I want you to focus primarily on the time between 2 o'clock and 4 o'clock, because that is the London Open. If we had described, as we did yesterday in real time, that we would expect to see some sensitivity at that level, which would be these bodies of the candles over here. Okay, and this is why you're not focusing on lower time frame charts, because if you're just doing 5-minute, 15-minute, or even hourly charts, you're looking at things in you're too close to the trees to see the forest. Okay, you can't see what you need to see in terms of the big picture. The market's being driven by this chart over here, not the 15-minute chart or the 1-minute chart or the 5-minute chart. Okay, price is being driven based on what this daily chart is giving us. So you need to trade with the expectation or directional influence that's available by studying what the daily chart is giving you. So if the daily chart is indicating that we want to go higher, obviously you want to focus primarily on looking at bullish scenarios in your lower time frames. If the market looks like it's approaching a resistance level, then you need to switch gears and start thinking, okay, I need to go to a reversal mindset. If we're in the middle of a consolidation on the daily chart, and we haven't really moved anything of significance higher or lower to a level where we would expect some resistance or order block or support, okay, then we have to expect consolidation. Okay, so we have consolidation, we have expansion, and we have reversal. Okay, that's the only thing we're going to focus on primarily. We're not going to look at anything else today. There's one more component, but I'm not talking about that one specifically here today. The other premise is that we expect the daily range to expand until 10 o'clock to 11 o'clock in the morning, New York time. So, given those conditions, we've expected yesterday that real time, we called this level at 130.93 potential resistance. So the market should find some resistance there. The market found resistance at 130.93. It went to a high of 130.94, only one more pip. Both candles had the same high, 130.94. One pip above it, and then crashed down, came back up, resold off at the bearish order block, which is a big up candle here. Any up candle prior to a down move, we look at the bottom of the candle to look for basically resistance. An institutional order flow, this is how you measure if there's institutional sponsorship behind the move. If you see price action, as I'm describing here and as I showed last night in the chart that I tweeted, every up candle, it needs to find resistance at that if it's bearish. So the market goes up, trades into that up candle, and then look what happens. It collapses. Price comes back up. What's it trade up into? The bottom of these two up candles. So that's a 30-minute up candle. Both candles being bullish on a 15-minute time frame. In time, that's basically a 30-minute chart, one bar. So it trades right up in the bottom of that up candle here, and it sells off, breaks down. This candle here trades right back up into the middle of the body of this up candle. It should sell off. It does. The market consolidates in here, breaks down one more time, and it trades right in the middle of this down candle. This down candle on a 15-minute basis is a breaker. It's a breaker on these highs here. It breaks the market that's short, that has stops above here. When it trades below, it hits that same level. Look at the sensitivity in the middle of that candle, that down candle right here. It hits it multiple times. The open on this candle is exactly at that level. The high of this candle and close at that candle is the same. The high on this candle is the same. And then finally expands and goes lower. Then we go into consolidation, which is expected at the time of the day, yesterday. Then we start a new trading session. Okay, we start at midnight New York time, which is right here delineated on Forex LTD. The 400 time is midnight in New York for this demo account. So now the expectation is what? If they ran stops, which is what they did here, old high, they ran stops. It did reject. We did break down below the origin of where the stops would have been accumulated to buy out these bearish positions that would have been held on here. Anyone that was short, basically, is what I'm saying, from this high, they got knocked out by this run up here. Then it broke down. Okay. Typically, retail traders are afraid at that point. They don't want to go back into the market and go short. They don't know what to do. They're scared. They're going to beat themselves up about having been right positioned on the marketplace, but they got knocked out and they don't want to get back in. So they're going to be stuck on the sidelines licking their wounds. So the market makers will beat them up with psychology. They won't get back in. Then they go into consolidation, going into midnight. In New York, what we start looking for is we want to see a market protraction. And that means the market needs to move away from consolidation, or basically expansion. Over here, this is the daily candle for today, which is still obviously developing. We haven't closed today's trading. It's only 9:30 in the morning at New York time. Our understanding is if the market's going to create a high or low in London Open, it obviously is beneficial for us to have the indication of what it most likely will form. Should it be a high or should it be a low? Well, if we know that the resistance level that we had noted did in fact materialize and showed a willingness to stave off future higher prices near term, and we came all the way back down and closed below these lows over here, that's not indicative of a bullish market. It's actually showing you a willingness that there is institutional selling going on, and you can test it and basically secure that as a truism by looking at price on the lower time frame. As we were just showing the delivery, every up candle gets respected as resistance. Every up candle gets resistance. Then you have a breaker here, and then market breaks down even more. We go into consolidation. At midnight, okay, what you need to do is you need to focus primarily on where is the institutional order flow reference points that are above the marketplace. Now, what do I mean by that? Well, the market started trading here at 0 GMT, which is what the daily chart on Forex LTD indicates on the daily chart. The opening, which is the top of this candle's body, that opening comes in at 130.40. 130.40. Okay? I'm going to show you what that looks like over here on the 15-minute chart in a moment, but for now, I want you to think there's two reference points that you need to think about when you're expecting market protraction. Market protraction is basically the Judas swing. Okay? The concept is you're going to see the market delivery of price go against the intended direction of the day. 90% of the time, the initial move that takes place after midnight New York time, that's usually the opposite direction where it's going to close on the day. Now, the problem is most of you don't understand how to trust or wait or study the higher time frame daily charts because it's too slow. You want to get in there in these 1 minute, 5 minute charts and make, big explosive little scalps. That's kind of like an oxymoron saying that together, but nonetheless, the daily chart is what you focus on primarily. And what specifically are you focusing on? Well, you know that yesterday we talked about the levels that would potentially provide resistance here, which it did. We closed down below these old lows. Okay, so that's indicating that there was some selling. We see that happening here in the 15-minute time frame. Okay, and now if we see this occurring, look what we have. We got another down candle in here, some consolidation. This candle's part of that candle here, down into this lower low. So we have all this consolidation right in here. I am not concerned about the fact that this down candle here, while it was a bullish order block for this move in here, we're looking at the context that this market went up here and ran out stops, and it hit a higher level resistance level, which is these bodies of that candle, as we noted yesterday in the video. We've taken out stops, we broke down. I'm not looking at this market here as a recapitalization of that bullish order block. This has now been neutralized. So I'm looking at primarily what was the driver that sent price higher. Looking at this, we have a very small little candle in here, but we also have this one in here. Because this swing high down into this swing low, I want to look at the entire range there. And this is the down candle prior to this little one in here. I want to look at this entire range. So how can I do that? By going up to a 15-minute time frame for that chart. Price is the same, okay? Price is the same. It's not going to change, okay? It's just giving you a different perspective on the same. Whoop, it's a little too aggressive there, Mike. All right. So now we have two solid, nice, beefy black candles Okay, indicating what? If this is a 30-minute chart, then we know this is what? An hourly chart. One candle down. Between this candle and this candle here, they're both both 30 minutes each. So that indicates what? This would be viewed on an hourly chart as one down candle. So if you go and change it to an hourly chart, you don't, good grief, I can't zoom in. You don't get to see the perspective of looking at in lower time frames, blending the two. See the difference between looking at the lower time frame and understanding between the two time frames. You'll get the understanding of what it is the price is delivering, but it's simply not, the answer is not always just simply going into your platform and clicking on a cookie cutter 1 hour chart or cookie cutter 4 hour chart. Some of you may have a 8 hour chart that's available in your time frame. Some of you may have a 2 hour chart. It's not answered by that. You need to look across several different time frames to get the perspective that price will indicate exactly what it is that it wants to do. In here, we don't see so much of the bodies. We see a lot of wicks. So when we go into lower time frames, it gives you more detail. But when you understand that two 30-minute candle together, back to back, that's the same thing as a 1 hour chart. See, looking at this perspective on an hourly chart, you would never look at this and say, okay, well, that's a breaker. It wouldn't indicate that. But when we understand by looking at the lower time frames, we can see that those two 30-minute candles are in fact the range from this high and that low. And we drop down into a 15-minute time frame again. Suddenly we have a lot more context, and we can see what was going on. The market moved back up into that shaded area, which is a breaker. They used the market buying in here to drive up price, taking out this short-term high. So all this in here is a breaker. You just study this whole little area here, that's a breaker. Market goes up and hits what? The lows, 130.60, more specifically 130.62 to 130.63. The high on today come in at 130.62, hit the level inside the breaker, and here's the kicker. Inside of the London Open, which is 2 o'clock, begins and ends 4 o'clock, that little window, that's London Open. That's not the ICT London Open kill zone. That's a little bit more in terms of time. But I want you to study this month. Every single day, I want you to note on your charts exactly where the London Open, and the higher low forms in regards to 2 o'clock to 4 o'clock in the morning. Okay. Some days it may form a little bit later into the 4 o'clock hour because there's news generally on cable around 4:30 in the morning. But when we use the London Open kill zone, we actually trade all the way into 5 a.m. New York time. So when I say we're waiting for volatility injections or high impact or medium impact news, when I say 4 o'clock, you're actually using the entire 4 o'clock hour to 5. But specific to London Open, when I say London Open, I'm only referring to 2 o'clock in the morning to 4 o'clock in the morning, New York time. That's a very small little window. But we can take trades earlier than this and a little bit later than this, depending upon what the economic calendar does, and more specifically what price is actually giving us. Because we don't trade just simply on our will or expectations. We have to trade based on what price is giving us. Okay, so you have to blend a lot of these things together. So now going forward, we would have our chart set up with midnight candle delineating the new day here, true day. And I'm going to show you by holding, I'm in the 15-minute chart now. So I'm going to hold down Control and tap Y. And that will show you the platform GMT, 0 GMT start and 0 GMT end of day. That's this little vertical line here. And if I hold down Control and tap Y again, it makes it go away. So that's how you add that on there. So there's 2 reference points in time that you need to be aware of. You need to know what this candle is, and then you note the open on that candle. This candle here is the one we're looking at. It's a green candle, so it's an up candle. So we go down to the bottom or the body of the candle, and we drop it right on the open of it. Drop it right there. And you double check yourself. Open 130.40. My level's at 130.40. So now, think about what we're doing here. We're looking over here at this daily chart at the time when it starts trading right there on this candle, this one right here, where this vertical line's delineating. That candle begins printing on the daily chart right there at that price level. That open on that candle is 130.40. So there's the opening. As soon as you see this at 8 o'clock in the evening in New York time, you delineate that on your charts, okay, because that could be the beginning of the protraction that we expect to see in the marketplace. That means if we have the context that we framed out in the open real time yesterday about this being resistance and the market should be reaching down into here, okay, 129.15 to 129.20. If we see these expectations, how do we use the daily chart? We use the daily chart the same way we use any other time frame. We look for institutional sponsorship. So how's that going to happen and pan out on a daily chart? You delineate the opening price on the day that you're going to study, okay, and then from there you're going to wait and see, do they set traders up with a rally from that opening price? Now, many times what you're going to see is the market really won't move very much higher or lower from the opening price at 0 GMT or 8 p.m. New York time. Over here, okay, this is where the day begins. Initially, it comes down a little bit. We don't care about anything going below that level. That's not our concern. We don't care about that. We know that we're focusing primarily on market protraction that goes above this horizontal line that we just added, 130.40. Okay, so at 130.40, our only real interest is when the market moves above this level. When it goes above it, we want to see, is it reaching for an area where price should encounter resistance, or it should take out stops, or it should mitigate. What is mitigation? Mitigation is where the orders that were used to buy here to send price up above an old high, when that's done, when the market goes below that low, those orders that are in the marketplace that are long, they may not get them all off up here because it's going to reverse too quickly. They buy here enough to send it higher, and but they load the market up with selling in here, crazy amounts of selling. They position those positions short against the buy stops that are ran out here. So now they're going to have basically two positions. They're going to have net longs here that are profitable all the way through here until they get to this level here. Once they get above this old high, they rush the market with sell orders to pair up against the buy stops that are resting just above these old highs. So their position is going to be largely net short while they hold a book that is net long from here. When price gets below that level down here, these positions are underwater. They're actually not making any money for them. They are not panicking because they're in control of price. They will wait for price, okay, to present an opportunity for them to drive it up higher. When it gets into this area that's shaded, this is where they're going to mitigate those longs that were underwater. They're going to take them off at zero loss or marginal profit. The way we expect that is we want to see the opening price at 0 GMT and the opening price at the midnight candle. And you can see here, this candle is the midnight candle in New York, which is 400 on the Forex LTD demo account that I tell everyone to use, so we were all having using the same reference point. The opening comes in at 130.41. Now, it's only 1 pip difference versus the opening price at 8 o'clock in the evening New York time, or 0 GMT on this platform, Forex LTD. Majority of the time, you're going to see from this vertical line that I'm showing here, which is 0 GMT, and then the vertical line here, which is 400, or basically in New York time, I want you to know it that way. This time is 8 o'clock in the evening, New York time. This is midnight in New York time. So you have 4 hours of price action. That is called the Asian range. Now, there's other people out there that delineate the Asian range in different manners. They'll use a little bit earlier than I show, and sometimes they'll go a little bit longer. I know Chris Laurie does till 12:30 in the evening. I don't need that because it's really midnight that everything changes over into a new day on the interbank level. So Generally what you'll see is there'll be a small little range that produces itself in between these 4 hours. That's exactly what you hope to see. This is where hope is allowed. You can't have hope while you're in a trade, but you can hope that the market gives you a setup that's along the lines of what you expect to see. So now we have a small little segment of price action. This small little area right in here, this blocked out space, that's the Asian range. Now in the Asian range, what will happen is at the interbank level, the algo will sit there and idle. It'll go back and forth, up and down, and it'll create the initial low of the day, and then it'll come up. It'll create the initial high of the day, and then it'll back off and go into consolidation, right going into midnight. Right at midnight, what you're expecting to see is what? Think. If we go back to the daily chart, we're not looking for signals on a 15-minute time frame or a minute or 5-minute chart or an hourly chart to give us directional premise. We're not doing that. We're using the daily chart. What was the context that we talked about live specifically yesterday, referring to this level up here, 130.93, okay? Then the lows down in here, the reaction that we saw here, okay? Just yesterday, that was like, what is that? Like 40 pips? Yeah, it's like 40 pips available if you were watching, go down in there. Okay, I'm not saying to trade that, but that's basically the London close trading scenario where you can take a short. We'll teach that in great detail too. But for now, looking at the opening price at 8 o'clock in the evening New York time, which is 0 GMT, then you have the opening price at midnight. You have only 1 pip higher here. So what we're looking for is we want to see price expand outside of this small little consolidation in here. Let me highlight it so I want you to see exactly. I'm going to tell you something, folks, and I mean this. If I would have known this as a new trader initially, I would have made $1 million on my first year's trading and had no luck behind it. It would have been, I would have known exactly what I was doing. But I didn't. As a new trader back in the 90s, early 90s, I did not know what I was doing. I got very, very lucky. But I want you to study these things as I'm showing you here in the chart. This is not limited to just this condition, this today. It's not form fitting. It's not cherry picking. I'm telling you, if you study the price action every single day and you put these notations on your chart, it will give you so much clarity about what the market is going to do. It blows everything else out there in analysis because technical analysis by far doesn't really work. There's no validity to technical analysis. What you're doing is you're putting lipstick on something to give it justification in your own mind. But that price movement had nothing to do with your notations on the chart. The algo has no idea about your harmonic animal pattern. It doesn't have any idea about your crossovers or your super settings on your stochastics or your MACD. None of that stuff matters. What matters is what I'm about to show you right here because it's about the money. That's all. So if we know that they have quickly blown out the individuals that were short by this run above an old high at an area where there should be mitigation taking place. See, they mitigated more of the longs they had back here. Remember, they took longs here to drive price up to take this area out and this area out here. So now they have a heavy net short book. But these individuals that have longs in here, they use this run up in here to get rid of that. That's why you saw this big sell-off on a 15-minute time frame right at that level. That's what all this was. They liquidated. So now they have a neutral book that's heavily net short. There's no longs. It's all short. They removed all their longs over here. They removed all their longs over here. So the book is heavily net short. So the directional premise is what? Indicating lower prices. So now we take that information And we transpose those ideas into our executable time frame, which is the 15 and 5-minute chart. But I'm specifically dealing with a 15-minute time frame because it's much more friendly for a new trader. 5 minutes, a lot more noise in it, but once you understand the things that we teach in this mentorship, you'll be able to drop down a 5-minute chart and just do amazing things with it. But you need to know what you're specifically looking for. But for now, knowing the range that was created between 8 o'clock in the evening New York time and midnight New York time, okay, that's the Asian range. So you as a trader that's focusing primarily on getting just in sync with the smart money or in sync with the interbank algo, you're going to wait. You're going to wait and sit on your hands and wait for protraction to come into the marketplace. And all that is a Judas swing up. Why would you be waiting for it to go up? Because above this range, initially, there's going to be buyers and there's going to be sellers below the lows. We do not care if the market trades initially after midnight, which is this line in here. If the market starts dropping down and goes below the low, we don't do anything. We sit and we wait. We don't care about that. That does not entice us. We don't feel like we're going to miss a move. We don't care about it. We know that the highest probability setups are going to occur when the market moves up above the Asian range high. That's the highest probable condition. Why would they want to do that? Because there's going to be individuals that are going to want to buy on a breakout above this initial day's high. Think about it. North America, okay, North American traders are stuck in this terrible condition of not having to have access generally to live trading hours that has the highest volume. That means between 9 to 5, okay, they're generally sitting at a desk or they're doing something. If they work construction, they're really early in the morning. Sometimes on job sites as early as 5 o'clock in the morning. So they're swinging a hammer, you know, laying concrete, putting brick on homes, tearing up asphalt, picking up trash, delivering pizzas in the afternoon. Whatever they're doing, they can't be in front of the charts. So what happens is they like to use the Asian session to do all their trading. Okay, and this is why guys that trade the Asian session get beat up a lot because they don't know what they're doing. They want to do these breakout strategies where they want to sell below the low and they want to buy above the high. Well, those same orders, okay, exist on the interbank level where if a transaction order comes in and say XYZ company or XYZ insurance company, they need to exchange dollars for pounds or pounds for dollars, vice versa. The delivery of that transaction, okay, will be offered to them above or below this range. And when those transactions are executed, it prints a higher high or a lower low. That's what the market maker will do. It's not always the market maker himself, okay, or the bank themselves taking that position. Sometimes they'll push a transaction in the marketplace to facilitate the raid because all they need is a market print one time at that level, and every order that's out there will become active. What I mean by that is above these highs, buy stops would be there in the form of new longs or protecting a short position. Below the market would be sell stops in the form of new short positions if price trades down there, or to knock out those long positions and basically preserve any additional loss. So you need to think, every time you look at price, you need to ask yourself, okay, what would be above the most recent highs and what would be below the most recent lows? And how does that fit the context of what the daily chart is showing me? If we knew that yesterday was leading into this resistance level like we talked about, we knew that this level was down here, we talked about that as well. We talked about this void down in here. We talked about the willingness to see the resistance hold back price. What day of the week is today? No matter where you're at in the world, okay, right now it's Tuesday. So Tuesday is a high probability day. It's a directional day where it's high probability. So if you know what the daily chart is most likely indicating, it'll give you a lot of confidence to go into the price chart and study specific sides of the marketplace. Only looking for what? We gave the context yesterday that 130.93 was the area at which price should not go any higher. Okay, we saw the rejection up here after we ran an old high. We've already covered in here institutional order flow where the sponsorship has been seen on every up candle. Every time they retrade into it, it does what? Expands lower. Then we created a breaker here. We have a small consolidation in Asia between 8 o'clock and midnight in New York time. We're not interested in anything after midnight going lower. We expect them to drive price higher. Why are they wanting to do that first? Why would they want to do that first? Because we want to take those individuals on the wrong side of the market first. We want to knock those individuals that are short already out. Because somebody thinks this is going to go lower. They see this big drop down and then consolidation slightly up as what? That's a classic bear flag. So if they're going to trade a bear flag, their stop's going to be just above the recent high in Asia. So by sending price above this shaded little area in here between 8 o'clock and midnight, they will put traders on the wrong side on a buying breakout, okay, that traders want to use to buy old highs and strength. They buy them a stop, so that way they can get in sync with their expectations. They're getting in sync with the market to go higher. Or it's to run the stops to take those individuals that are already out in the marketplace that want to be short. So they're going to be trying to get in early. The algo will expand up in price, okay, and that protractionary movement in price is what you expect to see. You do not worry about anything going down. That doesn't fit the model. The model would be you want to see them drive price up. That's this little tail right here. That little tail in the daily candle. That's what you're expecting to see. Because here's that opening price. The body of the candle here, that's the open on the candle. That's this level here, this horizontal line that we've indicated. So what you're looking for after midnight, you want to see price expand up above that. How far above it? Above the Asian range high and then into an area of institutional order flow. That is what? Well, we have an old low back here. We rounded down to 130.60. We also have the breaker here, which we indicated as well. So if we had a level that was indicating 130.52 was the middle of this down candle, okay, we can look for what? 130.50 because we're below the price. So you have to round down. So 130.50, that could have been derived at that level here. If you use what I showed you in regards to moving from time frame to time frame to zero in the actual range for that breaker, you end up with this wider range, and that is that delivery is this. The range is here to here, and equilibrium is right there, or the middle of that range that we've identified here. So we can take this and drop it to there. Okay, so we have the middle of the range here. So this is the equilibrium, and we expect price to reach up into that. Okay, we want to see price reach up into it. As you go forward, market hangs around that same 130.40 level. Look how much it spends time around there. Dips down one time, a little bit below it. Look at it does right there. See how it starts to sink down? You do not worry about that. Look what they did initially. They went below the Asian range low. Why did they do that? They want to get traders in on the wrong side. Why do they want to take those individuals in the market that are not short, but they want to sell on a breakout? They put traders in short right here. If they go short here, where is their stop loss going to be? Above the high right here. So now there's going to be more buy stops forming right above that high. Why are they putting buy stops there? Because anybody that would have been tripped in by a sell stop to get short on a breakout, their stop loss goes right above this high in the form of a buy stop. Now, think about what that's doing. That's engineering more liquidity so they can sell into these buy stops themselves. Remember, the condition of the marketplace is bearish. We've already framed that yesterday. So we have another block of liquidity forming above this initial high of the day during Asia, okay, during the Asian range. So there's buy stops forming up here. Once that initial drop down here, those individuals that were long, they get knocked out with a loss. But more importantly, those individuals that want to sell and break out with this bear flag idea, they'll send price right back above this area in here. Boom. That candle right there already knocks them out. So now think, are they in a hurry to get back in the marketplace now? Think about you. Say you're short. You just got knocked out. What are you thinking? I should have never traded today. I should have listened to my wife. I should have just stayed in bed. I should have never listened to that guy on the internet. Your psychology, okay, is all out of whack. You as a institutional minded trader now, you're thinking this is exactly what I hope to see. I want to see price come back above this Asian range for this very reason. Not just here, but you want to see it expand up into at least the 130.55 level, because that's the middle of the mitigation area, or where the breaker would influence price. It starts as early as this level here, 130.52, but it goes as high as 130.55. We watch price expand right up to 30.55 right there. And look what the time it is. We're inside the London Open. Okay, we're inside the London Open time frame. So right here, as price is going up, as it's going up, right there, as that candle is a screaming up candle, that's exactly when you want to sell. And I know what you're thinking. If I watched that live, Michael, I would be afraid to do it. And that's why nobody makes money trading London. Everybody that does this, okay, they get caught up in the move and they buy it because they think this is taking off for the day. They don't know how to use the framework at which we gave you yesterday. I told you the market would want to find resistance here. It's Tuesday. I told you that the London Open usually makes the higher low of the day. Tuesday is the usual day that the market creates the higher low of the week. Can't happen because we already have the high formed on Monday, but we know that the likelihood and context of the marketplace was not slanted for further higher prices. We're looking for lower prices, and I want you to study, go into price action, and look at these things. We're in London Open now. Price is rallying up, okay? We're going to say you sold it right at 30.55. You didn't catch any of this little movement here. Now you got to watch. Price goes up even more, a little bit more. It goes right up into what? 130.62. 130.62. That's this level right over here. But the rejection, exactly what you want to see. That's confirmation that you got exactly when the banks did their move. You're on their backs. Now you want to watch and see when this does this very thing here. You want to see them collapse and go below the Asian range again. Not so much this low here. You don't care about that. You want to see them get below the Asian range low, because what they did is they've trapped traders above the Asian range high. Those traders that don't trade with stops, those traders that are married to the idea that they're going to be right no matter what, they're going to be in this position long. Market does what? It immediately trades down below and traps everyone below the Asian range low. They're long up here. They're not going to give them an opportunity to get out, not even relinquish some of the losing position they're holding. They're not even getting a break. That's how you know you got the high today. Does it stay there long? No way. It's explosively moving lower. Market expands way down, okay? And we go into 5 o'clock in the morning, New York time, into 7 o'clock in the morning, New York time. That's London lunch. And you get this typical consolidation, slight little retracement. And then boom, we get another explosive move going lower. I should have had this screwed over a little bit more. Okay, and now as we get into New York starts for me at 7 a.m. New York time. So 7 a.m. New York time, you're expecting the market to go either into consolidation, go into a market reversal profile where it can go back into the daily range and go back up, and sometimes it can come all the way back up and clear out the high, which is the reason why you need to be available and awake looking at price at 7 a.m. I don't care where you're at in the world, your smartphone needs to have access to the charts. Just got to look at it briefly, see where you're at 7 a.m., especially if you're in a position carrying short term, or if you're day trading and you're in at London. You need to be able to manage your position by checking relative to time at 7 a.m. New York time. Because at 7 a.m., two things can happen. Well, technically, really three. The first is it'll consolidate and retrace and give you another sell-off going into London close, which is 10 o'clock to 11 o'clock in the morning. or it can just consolidate and go into the close of the day right at the low that's formed at 7 a.m. Or it can reverse altogether. It can have a market reversal profile. Market reversal profiles are typically seen as we saw here yesterday. That's a market reversal profile, where the market reverses and it trades all the way down and changes the direction of the day. Even though that the close is higher than the open, this is a market reversal profile. Some of them will have the actual close being below the opening. Doesn't need to be that. It just needs to show the reversal profile internally, which will give all the specifics about that. But for now, when we look at price action like this, we know that there's consolidation in here. Okay, once we understand this range, okay, we understand that there are specific levels at which we should see price reach up to, that 130.60. That's this level over here. So we have, and this level here, the middle of the range on that mitigation or breaker. We can put it on 130.60 again. There's that. Price hits that as well. And now here's where the stuff gets really interesting, and it's like voodoo. When you understand the Asian range, okay, and you're in a 15-minute time frame, you need to do this only in a 15-minute time frame. Do not try to apply this to all other smaller time frames, but in a 15-minute time frame, you want to delineate the range based on the bodies of the candles. Do not use the wicks. Now, in between 8 o'clock in the evening and midnight, New York time, this is the Asian range. And then what I do is I define it by the actual bodies of the candle. The wick I don't care about, so the lowest body is here and here, and the highest body of the candles in that range between here and here. In other words, between 8 o'clock and midnight time frame, I'm looking for the highest body and the lowest body of the candles. Once I understand that, and I delineate that, then I shade the area with that range. Then you can highlight it, and it gives you a standard deviation. So the market will want to do at least one standard deviation protractionary move higher, and that gives you this range here. Do not concern yourself with the wick, okay? With the wick. Don't care about that. You want to look at the bodies of the candle because that's where the bulk of the transactions are taking place. Look how the bodies of the candle stay within one standard deviation of the Asian range. See that? This is where all of the high probability selling is done, all in here. So if you want to sell just above this high here, okay, you got to understand that your stop has to be above the level that's shaded in here. So you wait and you watch as price goes up higher, 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 higher. The more you allow price to run up, the less your stop has to be. If you can't handle it and you're just too afraid to miss the move, you have to absorb more risk. Your stop has to be larger. So that means if you just try to sell above this high here, you can put a limit order before you go to bed and say, okay, I'm going to sell above these highs, and then put a catastrophic 60 pip stop. That's one way you can put an autopilot on London, because you got to allow at least 40 pips of protractionary movement. 40 pips. Not always is it always going to need 40 pips, but 40 pips is a general rule of thumb to allow for, because it builds in fudge factor. You're going to be early sometimes. You're going to not have the best placement. So if you use that in terms of a stop, you're well outside that reach for them to knock you out of the trade. And then what will happen is you end up seeing price go up. You would be short here. Your stop would be well a distance away. And then you'd wake up at 7 o'clock in the morning way in profit. And then you can adjust your stop later on and reduce that risk. So don't think that you have to be awake. And matter of fact, that's when you see me trade London, you're going to see doing things like that. I'm not going to be sitting here for 4 hours with you, because I can't do that. I mean, you wouldn't be able to get through all.